supply of funding has been falling. When reserves were abundant back in 2022, repo rates traded well below the Fed's rate. But now, reserves are at a 5-year low. Repo rates, they're spiking. So there it is. SOFR is spiking. Emergency borrowing at records. And reserves, they're at multi-year lows. So that right there, that's a liquidity crisis. The Fed sees this too. On December 1st, they're ending quantitative tightening, or QT. They're stopping the drain from the system. But here's the problem. Just stopping the drain, that's not enough. Because something else has been happening that no one's even talking about. Something that's driving demand for funding through the roof. This is basically a supply and demand problem, right? Supply of funding, bank reserves, has fallen over $4 trillion to $2.8 trillion. Banks now have less cash to lend, but demand, it's gone up. It's exploded. So far, volumes have more than doubled in 2 years, from 1.5 trillion a day to over 3 trillion. So we have falling supply and rising demand. When that happens, prices go up, right? That's why repo rates are spiking right now. But why did the demand double? The demand's coming from the government. The U.S. has $38 trillion in debt as of October 2025. That's 100% of GDP. Now, the debt's increasing fast by nearly $70,000 per second, heading to over $40 trillion. But we're not in a war. We're not in a crisis. Yet if you look at the spending, in 2025, the federal government is spending 23% of GDP. Now, for comparison, back in the year 2000, it was only 17%. During the 2008 Great Financial Crisis, it jumped all the way to 24%. During COVID in 2020, it hit 31% when they had to basically pay to keep the government open. But 5 years after COVID ended, we're still at 23%, still above the 2008 crisis levels. And it's not coming down. The CBO projects spending will average 24% of GDP for the next decade. Revenues, about 18%. So that means there's a 6-point gap every single year. The government is running $2 trillion deficits every year. And all of that debt, well, it's all going to be financed. The Treasury issues bonds. Banks, money market funds, and dealers, they buy those bonds. And they use the repo market to fund those purchases. That's why repo volumes are spiking. That's why they're doubled. Government spending is draining the liquidity faster than the Fed can replace it. And politically, there's just no way to fix this. Both parties agree on spending. They disagree on what to spend it on. Social Security, Medicare,